If you make a PML error, which will lead to a loss causing a PML breakthrough, then you can lose confidence from your reinsurance partners. Today we speak about surplus of lines and other proportional treaties. Surplus. Imagine you, as an insurance company, you define what kind of sum insured you can keep for net. But you want to write a larger amount. You want to have credibility from your brokers. You want to take a bigger share of the risk of the client. Then, on top of your retention line, you will ask for a number of lines above to your reinsurers. You may have one retain line for any kind of risk, say on the fire side. Or you may choose to have a higher retention on what you consider better risk, and a smaller retention on some other types, which are more hazardous. And then you will design a table of limits. The number of lines you buy from your reinsurers on the surplus basis will be the same. And then, for instance, if your retention on the top risk is 1 million, but on more difficult risk 500, you buy 10 lines, you buy 10 million reinsurance on a surplus basis for the best risk, and you buy 5 million capacity on the more hazardous class of risk. How do you design the net retained line? First, depending on your financial means, your solvency requirements. Second, you may decide to have one retention on any kind of risk within, say, your fire book, or different retentions depending on your appreciation of the volatility and the uncertainty of such type of risk. And then you will have different retention and what we call the table of limits. Your surplus treaty will give you accordingly 9 lines of business, for instance, for any kind of risk, but according to your table of limits. The third point will be, of course, the risk appetite of your top management and the shareholders. A fourth one, not to forget about it, will be the reinsurance cost it does mean. So if the reinsurance cost is too big, maybe you can decide only for 5 lines, or if it is smaller, then you can decide to go up to 12 lines. Normally, your retained line is expressed in terms of sum insured, but in some cases, and for instance for large industrial risk, you have another type of definition, which we call PML, probable maximum loss. And for these very big risks, huge policies involving different plans, you can assess with engineers, with risk surveyors, with the help from reinsurers to a PML, which will allow you to have a bigger underwriting capacity. Say you take 10% PML out of a sum insured of 1 billion, then you will have a 100 million capacity when without PML you would have 10 million capacity. So that's the way it can work, but you have to be careful not to mistake about your calculation on the PML. If you make a PML error, which will lead to a loss causing a PML breakthrough, then you can lose confidence from your reinsurance partners, credibility, and it may cost you a bit of money, it may cost you their support. Advantages, disadvantages, let's say, why you use surplus treaties. You use them for big industrial risk, capacity requirements, and many other types of such like marine hull, such like engineering, but it's rather for big risk. You will not use them when there is a difficulty to define a retention level. How can you have a proportional treaty when the cover is unlimited? That's what you can do with surplus treaties. If your capacity on one surplus is not enough, you want to buy on top maybe a second surplus treaty, and on top a third one. And it can be not endless, but it can be quite a number of. On top of the surplus treaties, you have additional capacities you may buy on the market. Some are called covers. That is to say, the additional capacity will still be linked with your net retention line. And you, as an insurance company, you can use the cover, and the reinsurance company will be obliged to accept it. But you can decide to go on the facultative market instead because you think you may have better conditions or for whatever reason. The cover does exclude, for instance, chemical plants. Then you go on the facultative market for reinsuring that. That's covers. On top of that, you have other types of treaties called facilities, called open covers, where you don't have any more links with your retention as insurance company. So the reinsurer gives you a cover without knowing eventually whether you will keep anything for your own on a net basis. So you may write whatever you want, cede to this facility whatever you want, while not having anything at risk for yourself. You can understand that such type of risk is, such type of treaty is not very attractive for a traditional professional reinsurer. But everything is a matter of negotiation, and negotiation is the salt and pepper of reinsurers' daily life.